We have a quick question here from Tando, who asks why certain high impact news releases sometimes don't move the market, and adds to his question how we can know what type of news or data points central banks are currently focused on. So thanks for the question, Tando. And the answer to this is actually much simpler than you might think. There are a couple of very simple reasons why certain high impact news releases might not be important for the market at a particular time. But before I get into these reasons, I do want to tell you the good news, and that is that you don't have to do all of the heavy lifting to try and figure out when that is the case. Because now that you have access to the Financial Source Trading Terminal, you will see that most of our daily and weekly videos and reports that we do does all of that heavy lifting for you already. We already go through all of the incoming data points and already do all of the analysis that we then share in the terminal to let you know which things are expected to be really market moving and which things are expected to have more of a muted reaction in the market. And if you just open up your terminal, let me just quickly go through that. If you open up the terminal, you will see that every day we have reports that we upload into our must-read section of the terminal. And one of them is actually called the Daily Risk Event Outlook Report. Now, this one includes a calendar of the incoming economic data points that we have for any particular session, what the markets are expecting from that, what the minimum and the maximum expectations are, as well as a list of the incoming central bank and political events that we do need to keep in mind. And what you'll see from this event every day, if there's a major one like today, we of course had NFP, we will have an NFP rundown and exactly what you can expect from that particular event. So we basically already do all of that heavy lifting for you in that Daily Risk Event Outlook Report. Apart from that, we also go through the biggest incoming events that we have in our very first video of the day. And that one is normally called a video that says a quick look at the markets as we start the trading session. This goes through all of the major themes that's moving the markets right now and what particular things coming up in that session you can expect to have a big impact in the market. And if there's something coming up like NFP, which isn't expected to be really market moving, we'll of course add that and explain that in those videos as well. Apart from that, we also go through the biggest incoming events for a particular day, or let's say for a particular week rather, in our top trading opportunities report. So if there's a massive event lined up, we will obviously go through that. And if there's something in there that just isn't really market moving, we will also just mention that in the daily as well as the daily reports as well as the videos we do. So having said that, let's just quickly take a look at some of the reasons why certain news events, which are considered as, let's say, high impact news, why they sometimes don't really move the markets. Now, the very first reason actually comes down to the calendars themselves. You see, most of the calendars out there that you get, they'll basically classify certain economic news events as either low, medium, or high impact, as you know. And these events are, they will classify them as low impact, high impact, and medium impact, mostly due to the historical importance of those data points. So what type of volatility the market saw from these events. And just because a data point has sometimes moved the market or used to be very important to the market, it doesn't mean that it will be very important every single time that economic data point is released. There are plenty of other factors which might cause the market to completely overlook a high impact or a red event, for example, and sometimes cause the markets to overreact on a seemingly low impact or yellow or orange event, if we use Forex Factory as an example. So to simplify this, don't ever expect that big impact events or high impact events like red events, that they will always be market moving, and don't expect that low impact events will always be have muted reactions in the markets. The expected impact comes down to a lot more than just the past volatility. Some of the reasons why events might be overlooked by the markets, let's say it's a red event. So let's take NFP like today. We had a very muted reaction in NFP today. And the reason for some of that might be that the overarching themes in the markets might just be taking center stage for that particular day or that particular week. A good example was, of course, the coronavirus that we had back in February. Let me just quickly turn that squawk down. The coronavirus, when that hit the wires, with all the economies around the world basically coming to a complete shutdown, it meant that the markets was going to see some crazy numbers coming out from data points. Some of them was the GDP numbers, right? We had a massive GDP miss coming out, of course, back in when we went into Q3, we had the Q2 number, which was negative 30% for US GDP, which is just massive. And if you go back to that event, it actually was a very muted event. You didn't really see any real impact in the market because it was already priced in at that time, firstly. And secondly, it just wasn't important because the market already expected a massive, massive number due to the coronavirus. Another one was the recent one we had in terms of the US GDP for Q3, which came in with a massive beat of plus 30%. And it wasn't really market moving because firstly, the market's already priced in that type of a print. And it was expected just from a base effect point of view after the massive rundown we had back in Q2 from the coronavirus. So, it really comes down to whether the markets are focused on those particular events, because there might be other overarching major themes that might mean that something like NFP or something like CPI just isn't important at that time. Another good example like today was the NFP number, right? So if we take a look at NFP, we can see NFP normally has a 3-star rating when it comes to Zenith, and it's a red event when you look at something like Forest Factory. And that normally means that, okay, we're expecting a high impact movement from this event. But NFP, even though it is usually expected to be a big market moving event on the calendar, in a week like this, nothing like NFP or even FOMC was really important to the markets because everybody right now is focused and anchored on the elections that's taking place, the US elections. So data points, even though they might have a high rating or high impact rating as being important, they can easily be pushed aside and ignored by the markets if there are other major themes at play that the markets are focused on. And again, these types of things, if that is the case, we will normally highlight that in our daily risk event outlook reports. And you can have a quick read through that NFP report where we did explain that, saying that, with the election taking place, let me quickly read this. I'd be careful to try and gauge which way the market will go on this one, especially with the election taking up all the attention right now. All right, so just keep that in mind. All of that information will already be shared for you in the terminal, but it really comes down to what major themes might be driving the market at any given time. And coming back to the major themes, we will mention that in our rundown, our major macro drivers for every single day, and we'll also touch on that, of course, in the videos as well. So another thing to consider for potential market impact is overall monetary policy, like you said, the central banks. Now, depending on where a central bank is in terms of the policy stance, certain data points will at sometimes be lesser and more important, depending on where they are in their policy stance, and more importantly, where the market thinks they are going next in terms of monetary policy. So again, a good example is where we are right now, with the majority of major central banks around the world basically hitting that lower bound in terms of interest rates and starting massive easy monetary policy regimes. It has meant that certain data points like CPI, for example, might just not be that important right now. If the market expects interest rates to stay at zero for a very long time, and your central bank, the current inflation target is, let's say, 2%, and core inflation is currently sitting at 1%, the market might not really care about that particular CPI print. Even though CPI is marked as a high impact tier 1 event, it might be, a very muted reaction because the markets aren't expecting that one single CPI print to really change the central bank's policy stance and change the central bank's policy regime. So where you are in terms of the cutting or hiking cycle for a particular bank is very important. However, this brings us to the third point, and that is that even though that's the case, the expectations going into a particular event and the expectations for a particular central bank is also massively important to gauge whether something will be important or not. Because if a central bank, let's say they are in the current scenario that we just described, if there are suddenly concerns about that 1% inflation moving lower, so let's say there's expectations about deflation, for example, like we have right now with the ECB, then suddenly inflation becomes important again, especially for the euro and for the ECB. And that can the CPI coming out for the eurozone right now will be much more important compared to CPI coming out for the US because the Fed right now, in terms of immediate market reaction, there just isn't really any major expectations coming out from that. Now, the other thing to keep in mind, though, is that even though all of that is the case, we do always need to keep in mind what the actual expectations are on the day and how the actual data point differs from the market's expectations in terms of the minimum as well as the maximum. Even if something is very important and highly anticipated by the market, those types of events will already be priced into the market before they occur, which means that the biggest market reactions from highly anticipated events and sometimes even slightly lesser important events will come down to how much worse or how much better the actual print came in versus the expectations. So if it's something that everybody's expected to move up and you've got a high bar for that particular event, if the market then surprises massively and you see a huge drop below the minimum or a big jump above the maximum, that can, of course, exacerbate that highly anticipated event. But if it's highly anticipated and it just comes in as expected, then you might either see a buy the rumor, sell the fact reaction, or you might see no reaction at all because it just came in exactly as expected and the market already priced in that move going into the event. And then similarly, if it's a lesser important event, if there's a huge surprise in actual, even though it wasn't highly anticipated and it might be a low impact event, it can still be market moving if the market is really surprised in terms of what the actual was versus the expectations. So Thando, I do hope that helps with your question. Any other questions, as always, please don't hesitate to let us know.